If you own tech stocks, gold, or crypto, this is one show you don't want to miss because Bank of America just issued a massive warning to all of their clients. They're saying one trade right now could upend the entire markets, and I'm going to show you exactly what that is, how the pros are positioned, and what you need to do right now. Plus, tonight's show is brought to you by Oncology's Biotech. You can find them on the NASDAQ and the symbol ONCY. And they're a pioneering company developing groundbreaking cancer therapies to help immune systems fight hard to treat tumors. If you're an Elliott Wave trader and you missed the last time they're on the show, well, they broke out from a wave 3 and now they're setting up from a move in wave 5. Stay tuned to the end of the show or check out the pinned comment or description for more information because this is one trade you don't want to miss again. Now, let's turn to Bank of America, where lead analyst Michael Hartnett, and I want you to understand, this guy is one of the best in the business, and this is what he said in his recent client note. But a disorderly unwind of the short dollar trade, this is anytime the DXY breaks over 102, and a reversal in the classic EMHY risk assets would trigger a bigger risk off in consensus trades of long yield curve steepeners, long global banks, and here's a big one, long NASDAQ. He also means gold and crypto because they're very key to the short dollar trade. And what he's saying here is very clearly, if the dollar were to rally, and I'm going to show you, it's already setting up a move here, and you see EM assets, its emerging markets start to fall along with high yield bonds. Watch out, we're on the cusp of a massive correction. And I want you to see the setup here. Let's take a look at this chart of the dollar ETF. This is symbol UUP. This is the 1-year chart, and it is a very clear signal that the dollar is about to break out here and in a major way. Because what you see across the horizon, that red line, that's the 1-year volume profile, and that's just where the most shares of this ETF have been traded over the last year. Now, if you like technical trading and chart trading, look at this. You've got a left shoulder, a head, and a right shoulder. So while you're hearing from the media right now that you need to dump the dollar, what you're seeing is there's massive amounts of buying. Let's look a little closer because you see that diagonal purple line that's kind of trending down. Well, what you're seeing is every time the dollar rallies up and gets rejected there, that's where people are shorting the dollar. Now, if it were to break out from here, this is a key point, you're going to see all these people that are massively short the dollar start to unwind those trades. They're going to have to close out their positions. They're going to have to go long the dollar, and that is going to upend the markets in a major way. Because when you talk about tech stocks, you talk about how they go up when the dollar weakens. Same thing with gold, same thing with crypto. And what is the big issue for a lot of investors right now? They're crammed into a small number of trades. But let's take a look at some of the risk coming forward and how the dollar can unwind, even though the consensus said the dollar is going to get a whole lot weaker. Even currency market players still view the greenback as locked into a bearish trend and are bracing themselves for further losses. But when you look at that chart, you see something completely opposite. You see a lot of support underneath there over this last year, and you see a lot of buying. And as long as those buyers hold, they're eventually going to squeeze these short sellers in a major way. And the problem is, underneath the market, underneath the price chart, and you can't see this, what you'll find out is the market is quietly reversing. What you're going to see in these charts is the market is already setting up for a big drop in tech. Let's first start out with the S&P 500. I want you to see this chart. This is breadth, and this is the percentage of S&P 500 stocks trading above their 50-day moving average. Now, why is this so important? It's because anytime a stock or an index is trading above its 50-day, it's considered bullish. Below, it's considered bearish. So in an index, as more of its constituents start to fall behind, it's a very bearish signal. Now, let's take a look at this 2-year chart here, and I want you to see very clearly where breadth in red goes, price follows. And it's a leading indicator here, and going all the way back to right around, say, May, you see breadth started to peak. Well, guess what? The economy started to peak. We've been talking about that for the last several days. What happened? Breadth has been on the decline and prices are rallying. So you can see at some point, this is called an alligator jaw. And at some point, it's got to close, meaning either stock prices come down or breadth goes up. Now, I want to take a quick look at the stock for our sponsor for today's show, Oncology's Biotech. Again, you can find them on the NASDAQ under symbol ONCY. And this was a chart back when we first featured them on the show. I said, look, they're setting up a wave 3. This is for Elliott Wave Traders. Was going to head higher. Well, sure enough, check this out. It rallied up to $1.44 following the show. It's pulled back in a wave 4 and now setting up its wave 5 move. And my friends, we've got 5 buy signals across our trading platform. Again, setting up for a potential big move higher. Stay tuned to the end of the show or check out the pinned comment or description for more information. Let's take a look at this chart of the NASDAQ 100 against the percentage of NASDAQ 100 stocks above their 50-day moving average. And you can clearly see people are cramming into a small number of NASDAQ stocks. Meanwhile, the rest are falling behind. And it's near an inflection point that's telling us that there's about to be a major correction. We even see that in the Russell 2000. In fact, you can see the relationship between breadth and price is far closer. Breadth is starting to fall off once again, and I've been warning about this, that it's going to drag price right down with it, and you can see now very clearly the issue at hand. So do you see why people are starting to buy dollars here? Because they're seeing breadth weaken, and this is something the pros know about. This is what Bank of America is trying to tell you. Look, if you are all in the equity market or gold and crypto or some combination of, you're missing the bigger picture here. We're facing a massive correction. And again, this was all built on one single trade. It's either short the dollar or borrow cheap dollars and buy risk assets here. So what happens if you see the dollar rally, all those people that are short, well, they got to cover. And all those people that borrow money in cheap dollars to buy risk assets, well, if those risk assets come down, they got to sell those to buy back those dollars. Again, you can see the unwind coming. But there's a problem here, my friends, because everybody thinks that rate cuts are bullish. And then that puts into question, if they were bullish, well, why are hedge funds dumping stocks in a big way? In fact, let's take a look at this chart here, because you can see very clearly U.S. hedge fund exposure toward Magnificent 7 as a percentage of their overall exposure. Now, second percentile in 5 years. And some experts are saying, look, they're going to have to buy back in and chase the market higher. Or what they're warning is of a massive reversal. And you can see very clearly they've been dumping stocks since about when? Well, probably right around April to May when the economy started to roll over. And you can see they're pulling back in a big way because they realize that breadth is weakening, that rate cuts in this case really aren't that bullish. And what's the other risk? We talk about this on a regular basis, machine positioning. Let's take a look at this next chart, because what you can see is machine positioning is sitting at its highest level in about 4 years, meaning machines are long a massive amount of U.S. stocks. And you can see what happens when they get to this upper level. Well, they don't hang out there too long, because what do? They raise their stop loss levels up, and when the market drops, they cut and run. So you can see the risks here, my friends, are massively building. BofA is telling you, look, the dollar's set to rally here, but you don't realize how many people are short the dollar or have borrowed cheap dollars to buy risk assets. But hedge funds, they know, and that's why they're dumping stocks. And what you can see when you combine the breadth indicator into this, we're setting up for a massive drop that the machines are going to be aggressively selling into. But if you said, Steve, rate cuts, they're bullish, you don't want to fight the Fed. See, rate cuts are bullish when it's an inflation story, not when it's a labor market story. You know, the thing people don't understand is they hear, well, the Fed's injecting liquidity. Well, they don't actually do that. Rate cuts are bullish and create liquidity when people borrow because rates go down. It's that borrowing that creates new money in the economy. That's the liquidity component here. But when the Fed's cutting rates due to layoffs, it's not bullish at all, because people that don't have a job, well, you got it. They're not borrowing money. And in fact, what happens is you start to see a dollar rally because you have too few dollars chasing too much debt. You may remember in yesterday's show, we talked about how we're sitting at a record amount of debt. But that's not the only risk that hedge funds know about and the Bank of America is warning about here. It's earnings season. Perhaps more worrisome is that aggressive corporate earnings growth is already priced into stocks, according to Citibank research. The firm says the market is pricing in an 8% earnings growth for the third quarter and forward growth expectations at a rate seen twice in the last 30 years. Both times came just before sell-offs, the first in 1999, the second in 2021. And this is something we've been talking about for months, because what happened during last quarter's earnings season? the analysts set the bar low. So companies could hop right over it and drive the stock market higher, and then the media push buy, buy, buy. And I said, watch out, because these analysts were going to raise the bar to a level that companies can't jump over as they unload the stocks. And you can see this is exactly what hedge funds have been doing. They've been dumping stocks since last quarter, knowing that they want the analysts to raise the bar. Companies can't get over it, and now you're facing a reality is everybody thinks that earnings season is going to be amazing. The problem is it's not going to be amazing enough to get over that bar. The issue is nobody's hedging. Everyone's trying to chase the upside on stock gains, but that's the risk to the rally because it creates a lack of downside protection broadly. This from Andrew Thrasher. He's a portfolio manager and technical analyst at Financial Enhancement Group, and he's right. Everybody is chasing the upside. And here's what you can do right now. You can start hedging your portfolio with dollars. So if you don't have that, you can start raising that. Now, there's two ways. You can go out and buy the dollar, but you may even want to take a look at profit taking here, maybe cut back on your some positions, add some dollars here, or just hold cash. And if there's a big pullback, then you can come back into the market. But the risk right now is nobody is hedged. Nobody thinks there's a downturn coming. And if it happens, and then you start to see the machines jump on board, watch out below. The dollar is set up for a massive surge higher. And with that, it would bring stocks, gold, and crypto all crumbling down. And now you know why Bank of America just issued a massive warning to all its clients and what you need to do right now. But even if we're on a cusp of a massive correction, there's always opportunities in the market, which is why we're bullish on this stock. For our sponsor for today's show, Biotech. Find on the NASDAQ symbol ONCY. Everything you need to know in the pinned comment and description below, because since we featured on our show last time, their stock's been up, and if you're an Elliott Wave trader, we think it's going even higher. Stay tuned. We'll take a look at the chart here in a moment, because Biotech is changing cancer care with PaleoRep, a therapy given through IV that helps the body's immune system find and destroy cancer cells. This one-of-a-kind method has shown great promise in hard cancers like those in pancreas, colon, rectum, where usual treatments just don't work well. And cancer hides in the immune system, but PaleoRep infects tumor cells, making them burst and send signals that wake up the body's defenses. It changes cold tumors into hot ones that get attacked, while leaving healthy cells alone, and boosts other treatments like chemo or immunotherapies for lasting protections. And cancers in gastrointestinal system are growing fast in people under 50, with pancreatic hitting 500,000 cases worldwide and a $3 billion market growing at 12% yearly to $9 billion by 2030. And pancreatic cancer now is a low 13% 5-year survival rate, but PaleoRep has doubled 2-year survival to 22% versus 9% in benchmarks, earning the FDA Fast Track and Orphan Drug labels. Oncolytics could bring the first immunotherapy approval here ahead of competitors and oncolytic virus treatments in this growing market. And they just announced on September 8th, PaleoRep in a colorectal showed strong efficacy with a 27-month survival versus 11 standard and KRAS mutant cases, plus immune boost, validating its edge in the $16 billion market. And this has got a bunch of key wins lined up. Anal data in Q4 2025, pancreatic full enrollment by late 2026, colorectal trial launch in early 2026, with September 16th update noting a 40% pancreatic enrollment in the U.S. and sites like Northwestern opening soon. Partnerships with Roche and Rutgers speed progress toward approvals in these billion-dollar markets, expanding PaleoRep as a platform therapy. And let's take a look at their stock price. Let's go back to what happened. The last time we featured on our show, we said, look, this is in the middle of a wave 3. If you're an Elliott Wave trader, was going to go higher, and sure enough, it did. It rallied up all the way to $1.44. It's pulled back right to its 21-day moving average. That's wave 4, now setting up the wave 5. And you can see this is based on my trading system. We've got buy signals across channel, Fibonacci, MetaStrategy Enhancer, base MetaStrategy, and even the Bravo 9. And safe in over 1,200 patients with mild flu-like side effects that fade fast, proven in 20-plus studies, and GI cancers taking billions of lives with markets booming to billions, PaleoRep offers hope with strong data and recent momentum. Keep an eye out on ONCY, and you can see very clearly, my friends, when you look at the stock chart, it's poised for a potential big move. But as always, with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades, and use your risk control levels when you do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.